Welcome. It's the Southern Fried Finance Podcast, where your hosts, Vic and Mike, will cover a host of topics related to small business taxes. They'll also touch on an occasional baseball topic, some college football talk in season, and maybe some out. And obviously, we'll talk about the best fishing spots and our best barbecue joints we've found lately. But it's a tax issue, y'all. So sit back, grab something to drink, and get comfortable, and join us for the Southern Fried Finance Podcast. And here's your hosts, Vic and Mike.
Well, hey, everybody. Thanks for joining. I'm Mike Ferris. I'm here with my buddy Vic Rouse with another episode of the Southern Fried Finance Discussions. Today, we're going to talk a little bit about SALT, state and local income tax deductions, and some nuances about charitable donations and stuff. My name's Mike Ferris. I'm a CPA in Longmont, Colorado. I've been practicing for a little over 30 years, have my firm for a little over 10, and work mostly with small business owners, some high net worth folks, solopreneurs, and folks that have some level of complexity in their tax world for one reason or another. So, Vic, how you doing today?
I'm doing great. Thanks, Mike. I'm Victor Rouse. I'm a partner in a CPA firm in Eden, North Carolina. Our firm was started by my dad in 1965. Dad passed away a couple of years ago, but I'm also partners with my mom. So my mom is my partner now. My mom became a CPA in the early 80s after a previous career as a high school math teacher. Anyway, our practice is diverse tax practice with a mixture of regular individuals and high income folks and business owners and retirees and partnerships and S corps and closely held C corps and a few large C corporations. So yeah. I'm a general kind of tax guy with a lot of different tax experience. But anyway, Mike and I have been working together for over 20 years. These podcasts are fun. It's always fun to talk about a new tax bill if you're into that kind of thing, which I guess there's not that many people that are into that kind of thing.
There's a few of us, but
that's just how exciting we are. But anyway, we're going to talk
1965, man, I wasn't even born when your dad started the firm. That's wild. I've got a colleague here in town that talks about that I've been practicing tax longer than he's been walking. And that takes it to a whole nother level. So, So this state and local tax thing, if you remember back in the summertime when this bill was being negotiated, the news talked a lot about this group of congressmen and senators that were stomping their foot to get an increase to the limitation on state and local taxes, and they got their way in large part. And if we kind of think about how this has evolved, in the old days, you just deducted all the state and local tax you paid as part of your itemized deductions. If you paid $10,000, you deducted that. If you paid $60,000, you deducted that and moved on down the road. But in 2017, they passed this limitation as part of the Tax Cut and Jobs Act that limited that deduction to $10,000. And that included not only your income tax, but your property tax. And if you have a personal property tax component, that too. So people in states with high tax rates and high property tax bills were limited in what they could deduct then. And that's been the case for almost 10 years. Now, we still have a limitation, but it's up to $40,000. So I think a lot of my clients will like this, Vic.
I think it's going to affect an awful lot of taxpayers. And what you're going to find is you're going to have a lot of taxpayers that are standard deduction taxpayers since the TCJA was passed, and are now going to be itemizing or going to be very close to itemizing in a lot of different tax years. So there's going to be some opportunities to maximize your deductions, your itemized deductions, or do a little bunching practice, we like to call it, where maybe we sort of plan to itemize in one year and maybe we go take a standard deduction the next. As most people may understand, you either get itemized deductions or you get standard deduction. You don't get both. So, for example, if my normal itemized deductions is very close to my standard deduction, and I can accelerate some of next year's deductions maybe by paying a property tax bill early, or paying
making your state estimated payment in December.
I can load those deductions in one year, and then the next year I'm just going to get a standard deduction anyway. So
And
anyway,
that's
and we
okay
can,
too. Yeah.
yeah, it is. And maybe we can put an extra couple $1,000s in a taxpayer's pocket that way, just by being a little bit strategic about the timing of these payments that you're going to have to make. I mean, you're going to owe that property tax bill on January the 5th. You've got a decision to
Yeah.
make on whether you're going to pay it in December or the
Yeah.
first couple days
When
of
do you pay it?
January. Yep.
When do
Um,
we pay it? Yeah.
yeah. And so with
So
the $10,000 cap that we had since TCJA, it didn't that part of the planning, we weren't really doing that so much because if it's $10,000 anyway, we were capped out. But now you're going to have up to $40,000 of state and local tax we can deduct as long as our income is below $500,000. And then I think it completely phases out. The increase phases out between 500,000 of modified adjusted gross income and
yeah,
600. So once you get over 600, you're back down to the 10,000
you're back
again.
down to 10. Yeah.
Right. So this doesn't help my very high income taxpayers, but it's going to help some middle income taxpayers and kind of upper middle income taxpayers. So.
Yeah. And I mean, a lot of my practice is in the 32% bracket. So most of my clients are below the 500 grand level, except for a handful that have some liquidation events or some bonus years and things. But for the most part, we're going to take advantage of this. And I don't
Yeah.
have that many clients that pay 40 grand in state tax, but that is a relatively large amount of state taxes. But if we pay, 15 or 18,000 or 20,000 in state tax, we've got 16 to 20,000 in a mortgage and 2 or 3 grand in charity, we are over the standard deduction threshold in that case. So this will impact things.
Yep. Yeah,
The
I think
nuance that really comes into play is for our clients that have entities, S corps and partnerships that pay state tax. One of the things that came out of TCGA when we were limited at the personal level, some really smart people figured out, well, if we amend the laws a little bit at the state level and make a business level tax that can be elected to be paid, maybe we can get an incremental deduction. And that has been something that we've tried to take advantage of. We call it PTE, pass-through entity tax. And so you can choose to pay the state tax at the company level, and in some cases create an incremental deduction that reduces the business income. And that's got some other things that go with it as a follow-on effect that may get a little deep in the weeds for this discussion. But increasing this personal deduction in a lot of cases may negate the desire to elect to pay the PTE tax. And so the planning gets a little more complicated here.
I think it certainly can get a little more complicated. I think most of the time, though, our taxpayers, our closely held business owners with pass-through entities, S corporations and partnerships, I think they're still going to want to make that pass-through entity tax election. That election is complicated because it's a little bit different in all the states that you operate in. North Carolina
Yeah.
has a very easy to manage pass-through entity provision where we can make the election. We can go in and out. We make the election at the
Mm-hmm.
time we're filing the tax return, and in Colorado, I think it's the same way.
Yeah,
But there's
similar.
other
Yeah.
states. New York's tried to make it as hard as possible. You've got
Of course
to
they
make
have.
the election way in advance. California's had some strange rules. But I think, in a state like North Carolina or Colorado where you can make the election at the time you're filing the tax return, and there's a number of other states that are just like that,
Yeah.
that you can decide then if it makes sense or not. Uh, you still want to make sure that you've paid your estimated tax payments.
That's correct.
Are
Pay
you
the
paying this
estimated tax payments at the right place.
at the right
So
place so you don't get a penalty? But I think generally, I want that deduction on the business return if I can get it. I want that state income tax deduction on the business return. Generally. Now there's some interplay with the 199A deduction
right.
where maybe I might be a little better off if I don't put it there. And that's the point of doing a good projection at the end of the year to kind of nail
Figure
down
out
this planning. And
where you are. Yeah.
yeah, and I think you can actually you are talking about thousands of dollars that you can actually save a person here if you can kind of nail that down and figure out exactly where you should be paying your state tax, how much, and when.
Yeah.
Um,
And it
you
is
know,
a very taxpayer specific decision based on their particular profile of other itemized
So
deductions. What tax bracket are we in? Do we have a high income spouse in the mix that puts us in a higher, do we have a loss coming from somewhere else that might offset the pass through income, and so we don't necessarily pay state tax at the end of the day. It's a really unique taxpayer specific decision. So the projections in this time of the year in the fall become even more valuable for those kind of clients. So
I think so too. I think it's important for the taxpayer to know we've got an increase in the deduction for state and local taxes. It might make you an itemizer instead of a standard deduction
yep.
taxpayer. And oh, if I've got a chance to be an itemizer, then maybe there's some things I can do to get some more deductions accelerated into 2025,
Yeah. What
right?
other
I mean,
things? Well,
there's some more opportunity.
and that is a great transition into the next little piece of this discussion for charitable donations.
Yeah.
You talked about bunching, and for years and years, I've talked with clients about bunching with respect mainly to charity, because it's one of the things that you really do have discretion over when you pay it. State tax estimated payments have a little bit of discretion, not necessarily a lot, but some. But charitable donations, sometimes we'll have clients choose to make, the first 6 months of 2026 donations in December of 2025, and that increases our itemized deductions for 2025 and decreases it for 26, and that's very much on purpose. So
Yeah.
couple of things that might drive some decisions. There's a little bit of changes with respect to charity. 2025, nothing really changes with respect to charity for 2025. However, in 2026, two things happen. On one hand, there's a page one deduction for people that don't itemize for, is it $1,000 per person, 2,000 in a joint return? Yeah.
That's right.
And so you get that on page one if you don't itemize. If you do itemize, your charitable donations now will have a threshold to overcome based on 0.5% of your adjusted gross income, kind of like medical has always had. So the first several $100s for a lot of folks of charitable donations won't be deductible in their itemized deduction calc. So that might encourage some folks to make some donations in 25 versus 26, or at least anticipate what's going to happen.
Yeah, I think that's a good point. We do a good bit of kind of charitable contribution planning with clients.
Mm-hmm.
We have a lot of clients with the increased standard deduction that we got in the Tax Cut and Jobs Act, that we had more and more clients doing qualified charitable distributions from their IRAs to satisfy the required minimum distributions. And that
Yep.
lowers your adjusted gross income and can have some other positive effects. Maybe lower your IRMA premiums and other things in the tax
Yeah,
return,
a lot of
right?
carryover effects.
So I think if you've got clients that are satisfying their required minimum distributions by doing qualified charitable distributions directly from the IRA to the charity, I think they're still going to want to do that. I don't think
Yeah,
it's going to change that part of the planning. You're still going to get to lower that adjusted gross income, and
that's a good
that
point.
may
That
help with some other things, like the other deductions that we talked about in our previous podcast, like the senior deduction and that sort of thing. If I can get my adjusted gross income down, then maybe that helps. But the 1,000, 2,000, that charitable deduction that we're going to get in 2026 going forward.
hmm
I think if you get back to what we were talking about with the state taxes, and maybe we're going to bunch and itemize 1 year standard deduction next, then maybe I do my big charitable contributions in the itemizing year, and then I'll do my small ones and still be able to get some tax
Yeah,
benefit,
yeah,
the
exactly.
1,000, 2,000 tax benefit on top of that standard deduction. I think it's a helpful provision. It's kind of the old the what's old's new again. We did something similar to this during COVID.
We
The
did. That's
dollar
right.
amounts were smaller. What were they? Is it 300, 600? Is that
I think
right?
it was 300 and then 600. Yeah, something like that.
Yeah, I
It's
think
fairly
so. But
small
anyway,
numbers.
it
So
was small numbers,
$1,000.
but
Yeah,
but it was something. It was something, and this is a little bit more. I think it's a good provision. That we at least get some kind of tax benefit out of making our charitable contribution deductions. I think, speaking of old things that are coming back, the old phase out calculations related to itemized deductions and that
oh,
sort
the
of
old
thing.
piece provisions. Yeah,
Yeah, that comes back next year in 2026 as well. So
That's
if you're
true.
itemizing next year, you're going to get a little bit of haircut. There's a
If your income's
floor.
fairly high, yeah.
Yeah, there's
Yeah.
a floor, the 0.5% of adjusted gross income that we got to be over. We got to beat that floor to get the deduction. There's some kind of, if you kind of look at the math of it, there's some interplay with this additional 1,000, 2,000, meaning kind of like, well, what's the floor? Well, if your income is $400,000, the 0.5% would be 2,000. Well, if I was standard deduction, I'd get to two, right, on the married filing joint return.
Yeah,
So
exactly.
it's
So,
sort of like the floor in there. At first, when I looked at it, I'm like, hey, why are we limiting charitable contributions? But then I started to think about it and like, oh, we really just sort of replaced it at these lower levels with an additional standard
mhm.
deduction. Maybe it's okay. It's just a revenue raiser in the bill. It's
Yep.
just
At
a
the end of the
revenue raiser.
day, it's
So,
mechanical, and
yep,
and I've had a couple of clients when the standard deduction became 30 grand for a married couple or almost 30, and a lot of folks didn't itemize anymore, and then they
yep,
started feeling like, well, I don't get any benefit from my charitable donations, and putting some of it on page one, people will get at least that much benefit. So that
yeah,
might
exactly.
influence some giving in communities and whatnot. So we'll see.
Yeah, I
Never a
think it's
dull moment, right?
never, never, never a dull moment. Um, but I do think, at least I worry a little bit about at least some of those taxpayers that have not itemized for a few years and they've kind of gotten out of the habit of keeping good
Keeping up with
records.
stuff. Yeah.
So we're going to have to coach them up a little bit and remind them that, hey, look, let's get this property tax bills together
Get the tax
um,
bills,
and
get
make
the
sure we've got
charitable
your
letters, and yeah, all
charitable
that good stuff.
contribution letters and all of that. So anyway,
Well, well, I think that's what we wanted to talk about with this little thing today. So
yeah, I think that was good, Mike. I appreciate it. It was fun as
yeah,
always.
you getting ready to go fishing anytime soon?
I am going fishing next week. Gonna have my favorite fishing captains down at the coast try to help us find some speckled trout. The
Right
spotted sea
on.
trout is my target of choice. They're beautiful. I don't know if anybody out there fishes for speckled trout, but they're beautiful and delicious. And I can't tell
And
you where
fun
we
to
catch
catch.
them.
They're fun to catch. So,
They are fun. They are fun.
well, have fun with that. I wish I was going too. So maybe next year. I say that
Yeah,
every year.
we need to get you back on the trip. My buddies are missing you. So,
Yeah. Well, y'all have a good time, and we'll catch up after you get back, probably.
all right, sounds great. I appreciate it.
Well, thanks for joining us, everybody. This has been an episode of Southern Fried Finance, produced by Michael F. Ferris, CPA LLC. Vic and Mike really thank you for being here and hope you can join us again next time.